Hey everybody, this is Ryan Mallory. Stock market crash update number 11. Sell in May, go away. Is that popular stock market expression going to hold up this time around as well? We saw a big pullback last May. We had a historic rally in April. We saw a little bit of weakness creep into the end of April. We saw it confirm into the beginning of May here. Let's see where this market wants to take us this week, because last week we saw an actual breakout of that consolidation box that I talked about in the previous update, and now we're right back into it. So it was a head fake. Here's the box of consolidation. We were in it for about 12 solid days. We broke out of it. We came right back into it before the end of the day, and then Wednesday of last week we actually broke out of it. Things were looking pretty good, but guess what? We gave it all up. That's the head fake. Those are the worst things to see in trading, because it shows a lack of conviction on the breakout. It shows that the buying has been exhausted, that it's used up so much of its resources to get up to that particular point of the breakout that it doesn't have enough buying left to really push it forward. That doesn't mean that can't change in the future. You throw another Fed stimulus in there, we'll probably react to the upside. But when you extend this box out, look, we are right back in the middle of that box, like the head fake never happened from last Wednesday at all. Now let's look at the Fibonacci retracements, because these retracement levels are typically what you see out of a dead cat bounce. When the market rallies after a severe correction, there's typically standard levels that it goes up to. The first one being the 38.2, the second being the 50% retracement level, and then the third, if the rally is really aggressive, it'll go up to the 61.8% level. Guess what we hit this past week? We hit the 61.8% retracement level, and look, it couldn't do anything with it. It couldn't break above it. It touched it 3 days in a row, could not push above it, and then we saw a sharp pullback on Friday. So maybe we do break back above it. If it does change the complexities of this market quite a bit, because the next retracement level will be like the 23% one, and that's not a one that you really see used all that much. So I think that the 61.8% retracement level that we touched this past week, I think it's important going forward, and it's one that we have to pay close attention to. Let's go back to October 2018 for a reference point here. October 2018, we had a huge sell-off. We had a rally in November, and then we had the crash in December. Very similar to what we're seeing here with the stock market crash of March, where we sold off hard, and then April, where we rallied. But where did we rally to back in November? Check this out. We went right up to the 61.8% retracement level. That is significant. And then what ultimately happened? I'll show you. We went significantly lower. We broke well below these lows here and tested this 233 level on the SPY. Big time break lower. That's still what I'm kind of anticipating. It's not a popular theory out there. I know in the comment section everybody's telling me, oh, everybody's saying that. I expect the exact opposite. And what's funny is that comment is the most expressed comment on my YouTube channel, is that, oh, we've heard everybody talking about retesting the lows. No, I've just heard a lot of people talking about retesting the lows and assuming that the market's just going to go straight back up. And also I would say too, because of our own personal biases, we look for the opinions that are not our own in the stock market for confirmation that our opinions are right. So I think a lot of that talk doesn't really hold a lot of meaning to it. I'm just showing you what I'm seeing on the charts, what I'm seeing on the technicals, and what I think will end up happening. I could be wrong. That's okay if I'm wrong, guys. I know that's not a popular thing to say hey, I could be wrong, but I could be. Okay? Stock market has a way of humbling everybody at some point in time. Maybe this is my moment. I don't know. But if it is, I'll play the direction the market ultimately wants to take going forward. I'm okay with that. But if I'm right, hey, I've been providing you some pretty clear details about why I think this market's going to go lower, and I gave you plenty of warning ahead of time. Now, when you go to the retracements back in like 1929, you had a 50% retracement. So this retracement has been a lot more aggressive than what we even saw during the Great Depression. That one was a 50% one. I wasn't sure if we were going to see a very similar retracement to that period, but it's not. We're seeing more of a retracement that's very similar to 2018. Now let's go back to the S&P 500 weekly chart, because you know what's interesting? We've had a lot of rallying. We felt a lot of bullishness. A lot of people talking about the bottom is in. We're going back to all-time highs. The S&P 500 has been down as a whole the last 2 weeks. 2 weeks in a row, 2 red candles. And the candles don't look that great. Not from a bullish standpoint. Look at this candle here. We did try to rally this past week. The last 2 days, we gave it all up. 3 days of strength, followed by 2 days of complete weakness. So when you consider all of this resistance that's in the May, June, July, and August time period of last year, and where we're starting to see prices run into some resistance, this chart doesn't look good. You got the 20-week, the 50-week moving average right above it. It's not able to break above it. But with that resistance overhead, this is an area for me where I'm saying to myself, if I've been buying this rally and if I've been benefiting off of the ride higher, I'm starting to book profits. I'm starting to raise stop losses, because I don't want to give them all back up and only see us retest the lows and seeing myself sitting with a loss. And all the charts are showing it too. You pull up QQQ. Again, 2 weeks to the downside here. It's not as bad because a lot of money has been flowing into the FANG stocks, the Facebook, the Amazon, the Apple, the Google, Netflix. They've all had good earnings reports. Amazon disappointed because they were going to be spending their profits on the coronavirus. So the market didn't like that, it sold off. Apple had a good one, but what was interesting about Apple is incredible earnings report, especially considering the environment we're in. They actually popped in the early going and then gave back all their gains. That's also a bad sign that the earnings was already priced into the stock, and now it's giving it back up. You're seeing sellers, you're seeing buy the rumor, sell the news effect. And so going forward, if you see Facebook, if you see Amazon, if you see Apple, Microsoft, Google, if you start seeing those names start to fade, that's going to be your sign that, okay, I need to start being a little bit more cautious with this market. We're already seeing a little bit here. We're seeing it with the indices down 2 straight weeks, despite the fact that we're at rally highs almost, but they're not going anywhere. They're breaking out of consolidation and then head faking and going right back into consolidation. What I become very concerned with on the daily S&P 500 chart is if price can break below 2720. So that's about 110 points away. If that happens, it's below its key support level and there's not a lot of support left until it reaches the lows from April. Once that happens, if that's taken out, then you're going to retest the March lows. If that's happening, you're creating fresh lows. So you can see where it can spiral out of control here. And with some of the big moves we've seen in the stock market, like Friday's 81-point sell-off, things can start tumbling really, really fast. And my clues for that is going to be if you start seeing volatility, if you start seeing volume both increase. And if you take the SPY, you've seen over the last 4 days, volume starting to creep up incrementally. Each day it's been higher than the day before. We haven't seen that a lot in the recent past. You also had the Fed come out with their FOMC statement on Wednesday. You saw initial pop, but then on the Thursday and Friday, the market sold off. There wasn't really much to go with there. They're not cutting interest rates anymore. It's at zero. Maybe they go into negative in the future. I don't know. I think that's a dangerous thing in and of itself. You also have a lot of rah-rah that's going on with this presser, with this FOMC statement where they're trying to build some confidence with investors. That can only go so far as well. Maybe they have another shot to fire, but they may be waiting for that if the market decides to test its lows or break those lows, and then they might come out with that as well. But in my opinion, if the Fed was going to come out with something here in the near future, they would have done it at that FOMC statement because that was when they would get the biggest bang for their buck. I want to also look at the Russell Index here real quick because this thing has shown a lot of strength in recent days. It had 6 straight days higher. But then on Thursday and Friday, man, it really gave it back pretty bad. It led the way on both days to the downside, including Friday's almost 4% decline. You look at the weekly chart of IWM, that is a very bearish candle here. That shadow there means that these are all gains that were given up at some point. It had gone as high as this point right here on this shadow at 136.75, and it has just given it all back up to 125. Around a 7 or 8% decline off of those highs. That's a big move. And while the index finished higher on the week for a second straight week, it didn't hold much of its gains. And the volume picked up. A lot of volume that was coming from the selling that was pushing that price right back down to where it almost started at. Now let's talk about the bull flag on the VIX, because for those who are not familiar with the volatility index, the VIX tends to go up when the market goes down. Traditionally, okay? Not always the case. Sometimes you have some divergences there, but it tends to show you the volatility or the risk that's in the market. You get more volume, you get more price, bigger price range, you get more selling. The volatility will tend to increase quite a bit. What you're going to see here is it's up 3 out of the last 4 days. It's trying to break its way out of the bull flag pattern. It's at the top end of that range, but it is still very well off of the recent highs from the March lows, where it was trading as high as 90, and now it's pulled steadily back all the way down to 30, and now it's popping. It almost saw 40 on Friday, and now it's consolidating there in the high 30s. But watch for a break out of that bull flag pattern, because if that does, I think it's going to signify a move into the 50s, 60s, and perhaps even the 70s. You got to remember too, it doesn't have to go all the way back to the all-time highs like what we saw back in March. If you go back to October 2008, the VIX peaked at 89. However, the price was not done selling off until March of 2009, where it kept going lower. So it doesn't necessarily have to go back to the 89s in order for it to break the March lows and to keep pushing lower. It just needs to get back up into that range. So we've had an epic rally in the month of April. We've had a dismal start to the month of May. Do we go back to the lows? I don't know. We won't know for sure, but I think we will. I think there's a good chance of it. I think that we're going to break those lows from March and push lower. People always talk about the V-shaped bottom. Yes, that does typically happen, okay? But oftentimes what we're ignoring is the fact that there's usually a dead cat bounce first and then the V-shaped bottom that happens much, much lower. But eventually it does happen. It happened in 2009, it happened in 2018, 2015, and perhaps we don't get the V-shaped bounce this time. 1987, we had like an L-shaped bounce. Great Depression was more like a U-shaped bounce. So we could see a different kind of bounce than what we've been typically used to over the years. So keep your focus in this market. Watch that box consolidation. Do we break back out? Do we break above the last week's highs? Those are all telltale signs about where this market wants to go forward. Do we break that 2720 level that I mentioned earlier in this video to the downside? If we do, that's a sign that there's probably going to be more pain down the road. We talked about the bearish wedge in recent weeks. We talked about the 2720 level. However, if we break below this support level going back to June 2019, that's also going to be a huge support level that's broken as well. That's going to lead to further downside. So what's the key to all this? The key is managing the risk. If you manage the risk, the profits are going to come, guys. But you have to manage the risk, because if you don't, then the profits mean nothing. You hit it big on a penny stock or you hit it big on Microsoft, anything, it doesn't matter. If you don't manage the risk, those profits are going to go away. They always do, okay? I'm seeing it with a lot of new traders right now, especially this past week, where they were all excited. They were buying into the cruise lines. They thought this market was breaking out, and then we got the head fake. Now they're down 20-30% in some of these names. They're getting their heads handed to them. They don't know why. Why? You didn't manage the risk. If you manage the risk, man, you're going to do okay. But you have to take your eyes and your mindset off of the idea that you're going to get rich in the stock market and that you're going to make a lot of profits. Yes, you can make a lot of profits and you can get rich in the stock market. However, it doesn't happen if you don't manage the risk. Keep your eyes on the prize, okay? And that prize is risk management. Manage the risk. If you like this video, I appreciate it if you would like and subscribe to it. I'm putting these things out a couple of times a week here. I'm always looking for new ideas in the weeks ahead. I know that some of you guys want to talk about Tesla with everything that we saw yesterday. I think I'm going to do a video on Tesla because I think you'll like it. There's a lot to talk about there, and whether you should even be trading it going forward. That's going to come out next week, so be sure to like and subscribe. You'll get notified, and it helps me to keep giving you this great content. Thank you, and God bless.